Welcome back, everyone. Today we'll be diving into a short report issued this week by Hindenburg Research on Icahn Enterprises. Icahn Enterprises, an $18 billion holding company run by the legendary investor Carl Icahn, who, along with his son Brett, own approximately 88% of the company. Carl Icahn got his name on Wall Street after a number of successful activist campaigns that would include aggressively purchasing shares of different companies in order to rattle management into making changes. Enter Nate Anderson of Hindenburg Research, a research firm known for its notorious short reports on companies like Afria, Nikola, Lordstown, and the Adani Group, and suddenly we have a Jerry Springer-style Wall Street shade-tossing fest on our hands. Now, before I get into this, I have to say I have no position in Icahn Enterprises, but I do find educational value in analyzing these short reports. You see, these reports are typically written by a group of smart equity analysts and are designed to ruffle feathers and shake the leaves, potentially causing retail investors to sell their shares, which, by the way, that retail selling may or may not allow the shorting party to cover their short position into. Intriguing, isn't it? That being said, I urge investors when they read these reports to not freak out and think critically. There are inherent risks in all equities. The question is, how much risk can you tolerate? Hindenburg's report claims that Icahn Enterprise units are inflated by over 75%, and that the stock trades at a 218% premium to net asset value, which is how much the portfolio is worth after deducting debt. A stark contrast to other star managers' vehicles like Dan Loeb's Third Point and Bill Ackman's Pershing Square, which trade respectively at around 14% and 35% discounts to their net asset values. Furthermore, IEP has the highest dividend yield of any U.S. large cap company at 15.8%, which Hindenburg claims that at that dividend rate, it equates to an absurd 50.5% of their last reported indicative net asset value. Let's dive in. Carl Icahn is known as the billionaire investor who's been shaking up corporate America for decades like a Wall Street snow globe. Icahn Enterprises, or IEP for short, is his publicly traded vehicle, which boasts a diversified portfolio with 7 operating segments and roughly $28 billion in assets as of December 2022. Icahn Enterprises operating segments include investment, energy, automotive, real estate, food packaging, home fashion, and pharma. They also own a large position in an investment fund made up of Carl's personal cash and money belonging to Icahn Enterprises, with an investment strategy focusing on buying names that nobody wants. Carl is a well-known activist investor taking large interest in undervalued names and forcing a new board or the sale of assets to unlock shareholder value. But let's not forget the infamous Icahn lift, the phenomenon where a stock's price would shoot up like a rocket after Carl would buy its shares. Nothing like a little Icahn magic to put a pep in a stock's step. And sometimes it could be quite fun. Let's stroll down memory lane to the great battle royale of Icahn versus Ackman when Bill Ackman's hedge fund Pershing Square Capital waged a crusade against Herbalife. Ackman bet big on Herbalife stock tanking, but Icahn played a different game, building up a 26% long stake in the company, all while saying that he neither liked nor respected Ackman. Herbalife stock skyrocketed, leaving Ackman with $1 billion bruise, while Icahn pocketed a cool $1 billion in profit. This isn't the first time these investment giants got into a fight. Back in 2003, Ackman filed a lawsuit against Icahn, accusing him of not paying investors of Ackman's fund at the time, Gotham Partners. Icahn bought a 15% stake in a company called Hallwood Realty Partners and agreed that he would pay out 50% of Icahn's profits to Gotham investors if he were to sell his stake in the next 2 years, which he did, and then he refused to pay off the amount owed to Ackman's firm. Icahn eventually lost multiple lawsuits around this contract, marking a win for Ackman. And then there's Nate Anderson, the fraud investigator from Hindenburg Research with an unusual talent for uncovering corporate shenanigans. Inspired by Harry Markopolos, the investigator who tried to warn the world about Bernie Madoff's Ponzi scheme, Anderson has developed a network to identify and expose shady business operators. Hindenburg Research has a history of critical reports, taking swings at companies like Tilray back when it was Afria, Lordstown Motors, and even Elon Musk's deal to buy Twitter, correctly calling that Elon couldn't back out of the deal when fanboys like Meet Kevin claimed he could. So when Nate Anderson issued a short report against Icahn Enterprises, you can bet your bottom dollar that Wall Street took notice. So let's get into some of Nate's arguments. He starts off with Jefferies, the only large investment bank with research coverage on IEP, and the ultimate cheerleader for Icahn Enterprises. Jefferies has been steadfast in their buy rating, like a dog playing fetch with IEP stock. They've been the exclusive conductor of IEP's $1.7 billion at-the-market offerings since 2019, selling those units to starry-eyed retail investors under the guise of a safe dividend. These funds, according to Hindenburg, are then used to fund the $1 billion in dividends issued since 2019. Talk about having your cake and eating it too. In their fourth quarter recap report in February 2023, Jefferies reiterated their buy rating. The bull case required assuming IEP's generous dividend would be paid into perpetuity in all scenarios, like some sort of financial fountain of youth. This led the Motley Fool to declare IEP a rock-solid dividend play, and Investor Place to list it as one of the top stocks to buy with your Social Security increase. Now, I have to say, if you are taking stock recommendations from Motley Fool, you're on the wrong channel, because we are way above that. Next, Nate compared IEP to its peers. Icahn Enterprises is a closed-end fund that trades at a whopping 218% premium to its net asset value, or NAV. For those not in the know, NAV represents the value of a fund's assets minus its liabilities, and it's a key metric for evaluating closed-end funds. Now, most closed-end funds trade around or at a discount to their NAVs. Just take a look at vehicles run by star managers like Dan Loeb's Third Point and Bill Ackman's Parachute Square, which trade at discounts of 14% and 35% to NAV, respectively. But IEP, they're in a league of their own, with a premium that's higher than all 526 US-based closed-end funds in Bloomberg's database. So why does IEP trade at such an astronomical premium? Well, it seems that retail investors can't resist the allure of a 15.8% dividend yield, the highest of any US large cap company, and investors get the chance to invest alongside Wall Street legend Carl Icahn. But there's a catch. Institutional investors have virtually no ownership in IEP. For comparison's sake, Third Point has a 3.25% institutional ownership, while Parachute Square sits at 6.8%. It's like showing up to a party and realizing you're the only one wearing a costume. Something's not quite right. In the world of closed-end funds, IEP is an anomaly that defies logic. It's like paying a 218% premium for a pair of shoes when there's a discount rack right next door. So retail investors have to ask themselves, is investing in IEP really worth the premium? But more specifically, if the premium is based on the dividend, is the dividend sustainable? As Nate points out, the company's outlier dividend is made possible, for now at least, because Carl Icahn owns roughly 85% of IEP and has largely been taking his dividends in units rather than cash, reducing the overall cash outlay required to meet the dividend payment for remaining unit holders. In other words, they are only giving out cash to at most 15% of shareholders. Now let's talk about IEP's three largest positions. The biggest chunk, a whopping $4.2 billion, or 45% of IEP's gross indicative assets, is in Icahn's private investment fund, which has seen negative returns for the last 3 years. Hindenburg estimates that this investment fund has lost over $270 million this year as a result of failed shorts. The second largest piece of the IEP pie is a 71% stake in CVR Energy, valued at $2.2 billion at year-end, making up 24% of IEP's reported gross indicative assets. But with CVR's equity losing around 14% year-to-date, it's estimated to be a $320 million decline in pro forma NAV. And Icahn's third largest reported component of their NAV is the automotive segment, valued at $1.7 billion and accounting for 18% of IEP's gross indicative assets. But hold on to your steering wheel, folks. This segment lost $88 million and $119 million in operating cash flow in both 2022 and 2021, respectively. So to sum it up, IEP's three largest positions have been putting on a less than stellar performance in 2023, like a debate team whose top performers are the Three Stooges. Now let's talk about margin loans. Picture this, you're sitting on a stack of stock and you want some quick cash. What do? That's right, you take out a margin loan. But like most risky ventures, things can get dicey. Enter Carl Icahn, who has pledged a whopping 60% of his IEP holdings, or around 181 million units, for these high-stake loans. Margin loans depend on high share prices, and if those prices decline, well, the lender might just ask for their money back, or more shares. That's called a margin call, and in a bear market, it's about as fun as a root canal. It's when a margin clerk demands that an investor deposit additional money so that the total value of the account is equal to a minimum set value in the contract. If they cannot provide additional capital, then the clerk will start to sell shares to reduce exposure. One of the major problems with margin calls is that they can lead to a sharp drop in share values when lenders sell at any possible price. And in the case of Icahn, the low daily volume spells a recipe for disaster, which could lead to a feedback loop of endless selling. The issue here is that Carl hasn't disclosed key metrics around his margin loans like loan to value, maintenance thresholds, principal amount, or interest rates. The thing about a margin loan is that it shouldn't be a problem so long as you can maintain your share price. It would sure suck if a short seller came along and, oops.
That would suck for you, right?
Well, folks, after diving into this Hindenburg versus Icahn Enterprises showdown, it's clear we're not dealing with a headline-grabbing scandal or a hidden treasure chest of corporate malfeasance. Nope, this is just good old-fashioned equity analysis, which makes it about as sexy as a bowl of lukewarm oatmeal. But wait, there's a twist. IEP's unsustainable dividend is being propped up by none other than Carl Icahn himself, who's taking his dividend in stock, which he can then hawk to a prime broker for a share loan. It's like watching a magician pull a rabbit out of a hat, only to find out it's just another hat. Now, this game of financial musical chairs might have you wondering if these prime lenders could find themselves in hot water at some point. After all, it seems like Icahn has discovered a cheat code that lets him access exit liquidity without actually exiting. But as we all know, every party eventually comes to an end, and sometimes the music stops before you're ready. The real question here is whether retail investors will wake up to the fact that they're paying a premium for a stock that's riding high on a house of cards, or if they'll continue to believe in the Icahn magic, even as the foundation starts to crumble beneath their feet. In the end, this Hindenburg report may not be the explosive expose we've come to expect from Nate, but it does shine a light on some questionable financial acrobatics by a Wall Street legend. And that, my friends, is the real story here. Sometimes even the greatest of magicians can't keep their tricks hidden forever. Because once you take a step back and pay close attention, you'll realize that the trick was much simpler than you ever imagined. It's just a matter of seeing through the smoke and mirrors. All right, everybody, thank you so much for watching. If you could do me a big favor, please hit that like button, subscribe, and ring that notification bell. Let me know what you think in the comment section. I love you all.